You're standing at a grocery store in 2019. A gallon of milk costs $3. You don't even think about it. You just grab it. Now, jump forward to 2024. That same milk, $4.70. You probably noticed that, but here's what you didn't notice. The version of you from 2019 is still making the same salary. Not metaphorically, literally the same money. Maybe a raise here and there, sure, but nowhere close to covering what things actually cost now. This is the inflation trap. And the uncomfortable truth is, it's not really a trap of circumstance. It's a trap we built. Before we go further, I need to explain why we're talking about this specifically right now in 2026. Because for decades, inflation was something that happened to other people. People in developing countries, people in recessions, not us, not here. The American system had solved inflation, or so we thought. Then 2021 happened, and suddenly the cost of everything started moving, fast. Between 2021 and 2023, inflation hit levels we hadn't seen in 40 years. Rent went up, food went up, energy went up. The average family's purchasing power, the amount of actual stuff their money could buy, dropped by thousands of dollars a year. And here's what made it worse. Most people got a raise during that time. Some got pretty good ones. But then they looked at their bank account and felt somehow poorer, like the raise was a sleight of hand, like someone moved the goalpost while they were running. That feeling wasn't paranoia, it was economics. So let's talk about what inflation actually is, because the textbook definition doesn't help anybody. Inflation is when the money in your pocket becomes less valuable, not because the bill itself changed, but because everything else is more expensive. Now, a little bit of inflation is actually built into the system. Central banks, like the Federal Reserve, they target around 2% a year. They think that's healthy. And there's debate about whether they're right, but that's not the argument we're having today. The problem is what happens when inflation isn't 2%. What happens when it's 7% or 8%, or when the government is trying to fix last year's inflation but hasn't actually succeeded yet. Here's the mechanism, and I'm going to try to make this clear without dumbing it down. When inflation gets out of hand, the government has very limited tools. They can raise interest rates to make it more expensive to borrow money, which theoretically makes people spend less, which theoretically brings prices down. But that takes time, like months or years of time. In the meantime, the government has already done something else. They've printed an enormous amount of money. Not literally, the money is digital, but the effect is the same. During COVID, the government spent something like $5 trillion to keep the economy from collapsing. That money had to come somewhere. Some of it came from taxes. A lot of it came from the Federal Reserve just creating it. Now, when there's more money in the system chasing the same amount of goods, prices go up. This is not debatable. It's just arithmetic. The twist is that people understood this was happening in real time. Economists warned about it. Inflation data came out monthly, and people watched it nervously. But by the time most regular people felt it in their paychecks and their grocery bills, it was already baked in. And here's the real problem. Once inflation gets high, stopping it creates its own crisis. Because now we enter what economists call a feedback loop, which is a fancy way of saying a vicious cycle that feeds itself. Here's how it works. Prices go up, workers see prices going up, so they demand higher wages. Employers, seeing that they have to pay more for wages, raise prices to cover their costs. Prices go up again. Workers demand higher wages again, and round we go. This isn't greed, by the way. This is just people trying to stay even. A worker in 2021 making $50,000 a year knows that in 2024 that $50,000 doesn't buy what it used to, so they negotiate for more. That's not irrational, that's survival math. But here's the cruel part of the math. Not everyone gets to renegotiate. If you're salaried in a job where you got a cost of living adjustment once a year, great, you caught up, mostly. If you're on a fixed income, Retired, disability, student loan payments that didn't adjust, you just got poorer, permanently. Meanwhile, if you own assets, a house, stocks, a business, inflation can actually work in your favor. Your house is worth more now, even though it's the same house. Your stock dividends are worth slightly less, but your shares are worth more because companies can charge more. You're hedged. But if you don't own anything except your labor, and you're selling that labor in a market where everyone's trying to get a raise at the same time, you're not actually getting ahead. You're just running faster to stay in the same place. This is why inflation isn't really neutral. It has winners and losers, and the losers tend to be people who can't renegotiate, hourly workers, people on fixed incomes, savers. Now, I want to show you the math that nobody talks about because it's genuinely disturbing. Let's say you're a teacher making $60,000 a year in 2020. That's a middle-class income, not rich, but comfortable. Inflation averages 6% for 3 years straight, not uncommon during the period we just went through. Your salary increases 3% per year, which was actually generous. Most people didn't get that. By year 3, your nominal salary is about $65,000. You got a raise. Good news, right? But that $65,000 has the buying power of about $54,000 from 2020. You're actually making less, even though your paycheck says it's higher. And this is before taxes, which, plot twist, don't adjust for inflation. So you're paying a higher tax rate on income that's nominally higher, but actually lower. It's like playing a game where the rules change but the scoreboard doesn't, and you only realize you're losing when you try to pay your rent. Now scale that up. Millions of workers experiencing this, all of them feeling poorer. Some of them actually are poorer. And the system just continues because the alternative to inflation, what economists call tight monetary policy, is recession, job losses, economic contraction. And politically, recession is worse than inflation. Recession is visible and immediate. People see it happen. Inflation is slow enough that you almost think you're imagining it. Here's where the story gets interesting because there's a real disconnect between what we're being told and what we're experiencing. You've probably heard that inflation is under control now, that it's come down from its peak, that the Federal Reserve fixed it. That's technically true. Inflation in 2025 was lower than in 2023. Progress, stabilization, good news. Except, and this is important, lower inflation is not the same as prices going back down. The milk that was $4.70 stays at $4.70. Maybe it goes to $4.80 instead of $5 next year. That's what lower inflation means, not cheaper milk, slower increases. So we've escaped the crisis, but we haven't escaped the damage. Prices remain high. Your real income is still lower than it would have been without all this damage. And the gap between what you have and what things cost is wider than it was. Meanwhile, the narrative is that everything's fine now, that we've stabilized, that we can all relax. And a lot of people do relax. They see the inflation headline drop from 8% to 3%, and they think the problem is solved. But they still can't afford the apartment they could have afforded in 2020. This is the cruelest part of the inflation trap. The crisis resolves while the damage remains. So, why are we setting up the system this way in the first place? Why do we tolerate this? Part of it is necessity. When you're in a crisis, a pandemic, a war, a financial meltdown, you need to act fast. You need to pump money into the system. That's the correct move. You don't want another Great Depression. You don't want total economic collapse. But the problem is that governments are not very good at turning off the tap. For decades after each crisis, the government kept spending, not as wildly, but still spending more than it brought in. The money supply kept growing, interest rates stayed low, and inflation, the slow killer, kept eating away at purchasing power. We've essentially decided as a society that it's better to have slow, grinding inflation than to have the short, sharp pain of recession or deflation. And from a purely economic perspective, maybe that calculation makes sense. Inflation is a tax on savers and a benefit to borrowers. Recession is a catastrophe for everyone. But that decision has a cost.
It's just a cost that's spread out over time and over millions of people, so it's hard to see. It shows up as the realization that you can't afford an apartment in the city you live in. It shows up as older people having to go back to work. It shows up as the persistent low-level anxiety that you're not saving enough, you're not making enough, you're doing something wrong. You're probably not doing anything wrong. The system is just extracting value from you slowly enough that you think it's your fault. So where does this end? That's the question nobody wants to answer, because there are really only three ways this resolves. One, we accept that inflation is the permanent condition, that inflation at 3 or 4% is just the cost of avoiding recessions. That's possible. Countries have done that. It's not ideal, but it's stable. Two, we accept that recessions are necessary sometimes, that trying to smooth everything out creates bigger problems later.
That sometimes you have to let the air out of the balloon. That's a minority position, but it has some legitimacy. 3, we fundamentally restructure how we think about currency and value. And I'm not going to get into cryptocurrency or MMT or any of these fringe theories, but the basic fact is that if we can't figure out how to manage money without inflating it away, eventually nobody's going to trust it. And that's a much bigger problem than anything we've talked about so far. None of these outcomes are certain. The system's been running like this for decades. It might keep running. It might not. But here's what I know for sure. The inflation trap isn't a trap for everyone. It's a trap for people who sell their time and hold cash. For everyone else, it's just the cost of doing business. And if you're in that first group, and most people are, then the real question isn't whether inflation is coming next. It's whether you're going to keep waiting for it to be someone else's problem to solve.